In the last 7 recessions, only one had what I would consider a major impact on housing. Hey, it's Kevin A. Malsh, Pine Financial Group, where we work together so you succeed. Hey, you found us here on Facebook, you found us here on YouTube. Please hit like, hit subscribe. We really are trying hard to build a channel so we can help more real estate investors just like you. More investors will see the content if there's more subscribers. So please subscribe. It would really help me out. The housing crash is coming, you guys. The bubble is about to burst. Well, at least that's what we're reading in the media. And I read some headlines today. The bubble is about to pop. Home sellers slashing their prices. The media is trying to get us ready for something that may not even happen. You know, I get questioned maybe once a week or so about the 2008 crash and how it compares to today in the recession we are either in or going into. Look, I was doing this business in 2006, 7, and 8. I was both a real estate investor with over 50 rental properties, and I was a hard money lender at the time. So I went right through that crash. Believe me, I understand the fear. That was a challenging time, to say the least. But I want to give you today 6 reasons why this recession is not the same as what we saw in 2008. Number 1, credit scores. Credit scores are much, much higher now than they were on loans back then. I'll give you some statistics here. So I'm going to look down just so I could read these to you and make sure that I get them exactly right. Back then, 2006, when we were at the peak, 26% of the loans that were out on real estate were to borrowers with credit scores of 660 or less. Okay, 26%. Only 24% were at 760 or higher. So you can see it's about the same number as really great credit and not great credit. And I should mention this, credit scores are a terrific way to judge somebody's willingness to pay if they get into some type of trouble. If you see a history of I'm not going to pay this bill, or any track record like that, obviously it's an indication of their credit worthiness. So today, if we're looking at right now, 2022, only 6% of the borrowers have less than a 660 credit score. So 26% then, 6% today. And we have 68% with a 760 or higher. So you can see it's way heavily weighted with high quality, good credit borrowers. So that's number 1. Number 2, tighter credit. And I want to share my screen with you and go through a little graph here and what you can see, because I think the graph is a fantastic visual on why I would expect more of a soft landing than we saw in 2008. Okay, I'm assuming that you could see this graph here. So this comes from the Mortgage Bankers Association. And all I did was go to their website and scroll down to their most recent press release. Okay, and I clicked on the press release and I come down to this graph down here that was pre-crash of 2008 all the way through 2011. So you can see this dramatic decrease here. Actually, let me explain what this is. This is a mortgage credit availability index. It just measures from 0 to 1,000 on a score of 0 to 1,000, the availability of credit. So how easy is it to get the credit? Interest rates play a small role, but it's really about down payments, credit scores, income documentation, all the things that make sense when you're making a loan to somebody buying a house. So you can see the very peak up here in basically the summer of 2006, highest it's ever been. About 900 was the score at this point. And then you can see just a dramatic decrease as banks starting to tighten up and react. I was going to say prepare. They didn't prepare. They reacted to the credit crisis that was going on in 2007 and 2008. And then you can see we had really tight credit. It was hard to get loans, meaning much higher quality borrowers. It actually went under 100, and it's been floating between 100 and 200 ever since the credit crash. It started to creep up here. It was closer to 200, and then you see COVID took care of that. So March of 2020 came back down to 119.6 is where it was at the, this says 2011, but really this is December of 2021. And I just read in this June report, it's currently at 119.6. So pretty tight credit now and has been ever since the crash of 2008. Okay, number 3, inventory. Inventory is much, much less than it's been since 2008. And I want to share my screen again and show you this other chart here. So I thought this was actually pretty fascinating. So this is just a chart of the top metro areas. And we're looking at Q2 of 2006, which was, again, the peak before the crash, compared to Q2 2022, which some people believe is the peak before the crash. And you can see, if you look at this, it shows inventory at 2006 compared to inventory today. And you have a few that might be concerning here: Austin, San Antonio, Dallas, Boise. So these have a significant increase in inventory since the crash, which could be some type of indication of a correction. Look at 178, 108% increases. And also, what I like about this chart is it shows population growth as well. Now, these have been growing like crazy since 2007 or 2006. And so you would expect to see more inventory because there's more people. But if you look at this, only the top 4 here have a higher increase in inventory compared to an increase in population. So 4 of all of these markets would be what I would consider concerning. Then you have all of these that have much, much less inventory. And if we focus on the markets that we spend a lot of time in, Denver and Minneapolis, for example, look at this: 17% less inventory with a jump in population. Minneapolis, 26% less inventory, again, with a little pop in population. So these are, I think, good indicators that inventory is way low. Even though we're reading some headlines, inventory going up, it's still way too low for the demand, and the inventory that's on there will be absorbed quickly, which will help soften any kind of correction that we're going to see. So that was number 3. Number 4, history. Now, history does tell us something. Now, we can't just rely on history and hope that it plays out exactly like we predict, of course. But it is interesting to know that in the last 7 recessions, only 1 had what I would consider a major impact on housing. Of course, we're talking about 2008 and the credit crash. So back then, it took 4 years, about 4 years, to go from the peak to the bottom. Drawn out, long recession. It just went down, 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 down. And it took about 2 years to recover. Recovery meaning that the median price per home was back to the level pre-crash. Okay, so 4 years, 2 years to recover. If you look at the other 6 recessions combined, I'm just looking at the average of the 6. Okay, so I combine them all, look at the averages. None of them had huge impacts on housing. We have an average of a 6-month decline. That's half of a year of declining prices, and then the recovery. And the recovery took a little bit longer than I was actually expecting. It took about 14 months on average to recover. But you could see that there's a big disparity between 6 of the last 7 recessions and the one that was really focused on housing that we're all so concerned with. The reason for this is the 2008 crash or recession or whatever you want to call it, that was focused on housing. That was because of loan defaults on housing. It was really that created the whole mess of the economy. This one is different because it's not created by housing. It's created by inflation, which the government created for us. Thank you very much. Now we have high inflation, so the government's response increased interest rates, and that is throwing us into a tailspin. So it's not focused on housing. It's absolutely focused on inflation, which is completely different than 2008. Okay, equity. You guys, there's more equity in properties now than there ever has been in the history. We have 2.5% of all the loans out there have homeowners with less than 10% equity, 2.5%. Back in 2006, it was 25%. And I've read several articles on this, and there's some mixed data and information on this. But for the most part, most agree that our equity position is about 55%, meaning on average, we have a 45% loan to value ratio. Equity provides options for homeowners. So having record equity will help if there's any downturn. So again, I'm thinking more of a softer landing. And number 6, finally, regulation. Can't go without saying this, right? There wasn't any in 2006. And that's why you had stated income loans on investment properties with low credit scores. That's why you had 125% loan to value ratios. You had subprime loans. You had negative amortization loans. So you had lots of loans because of the greed and no regulation around it that were just destined to default. Now, we didn't see that then. Looking back, we could see that. So again, regulation, we have Dodd-Frank, we have ability to repay, and we have all of this helping support the industry. Some people would say over-regulation, but in any case, it's definitely helping keep us all safe. So those are the 6 reasons I think we have more runway, and I do think we'll have some decline, or we are going into a recession, but I believe it will be a softer landing, much softer than we saw in 2008. But wait, there's one bonus section. I couldn't find too many real good statistics about this, so I'm putting this as a bonus instead of one of my 6. But I do believe that there's pent-up demand. We have institutional investors. We have mom and pop investors looking at the housing market and just saying the price too high. So if there is any correction, we start to see prices come down, I think they're going to swoop in and create like a floor so we won't see a big drop in values like we saw before. And we have first-time home buyers and homeowners that weren't able to compete with the market. I mean, we have all cash, closing 1 week, and over asking price, right? Multiple offers. So your FHA buyers were just out of luck. Nobody wanted to take FHA loans when they're getting full cash, full asking price offers. Now, they're still qualified, maybe for a little bit less because of rates, but they are qualified. And I believe they're still out there looking for property. So those are my 6 plus bonus 7 reasons why I think that we're not going to see a big drop or a bubble burst like we saw in 2008. Now, don't let this, I don't want this positivity to conceal the fact that I do think we're going to have some impact from this recession, interest rates, inflation. We're going to start seeing some job losses and layoffs and that kind of thing. I do believe all of that's coming, but I don't believe it's a big enough impact to stop what you're doing, stop investing in real estate. I would just say proceed with caution. If there's negative influences, for example, big commercial buildings, busy roads, railroad tracks, something like that, I might stay away from those properties right now. I mean, I'd be buying for cash flow, or if you're flipping, I would buy properties that you could be in and out of quickly so you don't get caught up on any major recession that potentially could be coming. I hope you got some insight in this video. I'm dying to know if you agree with me or not. If so, please leave me some comments below, and please don't forget to hit that subscribe button. Thank you. Check us out, pinefinancialgroup.com.